Hello everyone, I'm Steve Savant, syndicated financial columnist and money-colored commentator. On today's show, US and Foreign Indices, part 3 in our series on index investing. Well, welcome to our third segment. We're talking about basically adding on the idea of US and foreign indexes. We'll talk a little bit about some of these other indexes, which you don't even think as an investment because they're really not, but they're indexes anyways, a barometer of where the economy is going. So one of the things I like to do sometimes is look at some of the oddball things out there. Not that a lot of people are into, foreign markets on commodities like silver, gold, the heavy metals, or cattle, or hog futures. Although there's not much of a future for hog, but you're looking at commodity indexes. That could be a way to go sometimes too, especially people that are rural area Americans. They think they know what's going on in the market. They want to invest in something that actually is related to what they do in their vocation. So sometimes they'll choose this. What happens in the commodity marketplace that has both immediate and long-range impacts on the economy? For example, when indices tracking those markets are slightly up or down in comparison to previous year, it may indicate a period of volatility is likely. Right now, as we are recording this session, since February and March, we've had some very volatile times, and those times may not be over for a little while. So sideways markets, hopefully we're in for the long haul. If you're a senior and you're within 5 years, you need to start thinking about how much risk you can take. Most of the people that really quantify some of the danger periods are 5 years before retirement and 5 years afterwards. So if you're in this period where you're 5 years or less and we're going through a sideways market that we have now, you need some serious handholding and get your registered investment advisor or registered rep to go and help you walk you through this. You're going to need that kind of handholding. In my view, it's really good to be escorted through troubled times through somebody that knows what they're talking about. For example, when indices tracking those markets are significantly up or down in comparison to previous years, volatility is likely. The best known commodity indexes, including the Thomson Reuters Core Commodity CRB Index and the S&P Goldman Sachs Commodity Index S&P and the Dow Jones Commodity Index, each track what are different elements so that you can get an idea where is the marketplace going. These are big indicators. Thinking of it, some people like to take the economic pulse from basic indications of where the economy is going. They might look at the index of leading economic indicators, which is a primary tool for forecasting changing patterns in the economy. The 10 components, which currently include the S&P 500, the average work week, the average initial claims of unemployment, are adjusted for time and to help to come with an accuracy of index. So they're putting the S&P 500 and unemployment, and they're putting that as part of the active components inside the index of leading economic indicators. The Consumer Price Index is compiled monthly by the U.S. Bureau of Labor Statistics and is used to gauge inflation by measuring the change in prices of basic goods and services. The CPI, though widely acknowledged to be less than a perfect measurement, is usually benchmarked for making adjustments in Social Security. And again, remember, we're still hoping that Congress comes to the table and it makes some adjustments specifically for seniors and what we buy and sell. There has been a great debate on the CPI. We don't think this is accurate. We don't think it includes the things that Americans actually spend, but it's all we have right now as an indicator. Hopefully later we'll actually get something that'll come on and add to our thinking on the Consumer Price Index. And then the last one, the Employment Cost Index. The Employment Cost Index is published quarterly by the BLS and measures the growth of employers' compensation or the cost of labor. And in private industry as well as in the state and local governments. Many economists look to the ECI for inflationary warning signs, and a greater than expected increase in the index is often seen as an indicator of rising inflation. And right now, think about it, we've seen the Fed now moving up small little eighth of a point here and there. You're going to start seeing a accumulation effect now. We're going to expect to have maybe 2, maybe even 3 more Fed moves before the end of this year in 2018. So we want to look at that. They're looking at this and they're probably making a judgment call at the Fed saying, look, we're a little worried about inflation. We want to make sure things stay in line. So they're rising the interest rates to tamp down any kind of crazy inflation that would bring numbers up and through the roof. When I first was married in the 70s and early 80s, the inflation rate was double digit. Everything just kept moving up until we finally had a rest. And when the Reagan administration came in, it kind of helped a little bit, not a lot, but it helped us tamp it down. And by the time we got into Bill Clinton's administration, we started seeing a little bit better economy and a lot more balance in the spending of the government and a balance sheet. How about that? There's something you haven't heard in a long time. Now, I want to kind of walk in and show you this U.S. and major indices, and we'll just go through the first one first, but it's pretty long and pretty wide here. So let's just walk through here. There's some of the ones that you may be looking at, and you've heard about them, and you can always ask your registered rep and advisor, does he have any ones that he likes? Does he think they're winners, right? So the S&P Dow Jones Indices, right? You can go, and then you have the S&P 500. Capitalization weighted U.S. companies with capital over $3 billion. So that's the entry mark to be playing. If you're a company in there, U.S. companies with capitalization over $3 billion just to make it into the S&P. The S&P 500. It also, remember, has equally weighted, same as the S&P 500, and the S&P Small Cap 400, capitalized weighted, but it's 750 to 3.3 million in the market of capitalization. You walk down and you'll see all the ones that are listed here. The Small Cap 600, the S&P Composite 1500, the S&P US Total Market Index. Remember, many of these are available with annuities and index life insurance and some variable life insurance as well if you like the taxes. And if it's done right, it could be a play, especially not only in taxes, but it could save you some real money in other areas, in my view, in indexing, especially Index Universal Life. It has a hedge to it. You may want to talk about that. I've talked about that before, and you should watch one of our previous episodes. I have S&P 1200, the S&P US Total Market, the Dow Jones 30, the Dow Jones 20, the Dow Jones 15, the Dow Jones 65, the Global Dow at 150. You walk over here, you're dealing with Wilshire indexes, the Wilshire 5000 Total Market, all US equity securities, the Wilshire 45 completion, that's all US securities, but they're all large caps. Notice how they're dicing and parsing some of the definitions here. The FTSE Russell, the Russell 3000, the Russell 1000, probably the most popular one that most people know are the Russell 2000, and then you have the Russell Mid Cap. You also have these exchange indexes over on NASDAQ. You have the NASDAQ Composite, you have the NASDAQ 100, you have the New York Composite, and the New York US 100, and I think there's some more underneath here. Let me just see. Oh yeah, and you have the New York International 100, the New York US 100. You have value line indexing and value line indexes. Both of these two here, one is rhythmic and the other one is geometric. They're around 1,700 each of them. They somewhere in that vicinity. They're all equally weighted. These are some that are some obscure. I admit it. It's not out there a lot. And then there's a couple I missed over here: the Asian Dow, the European Dow, the Global Dow. And you're looking at all these opportunities, and they're all within it. Remember, I'm thinking of even some of the insurance companies are involved in this, like Voya has a product out there where they would take indices from Asia and indices from Europe and indices from the United States, and then they would give you the choice. If one was not really in favor that year in performance, you could actually drop that as part of your strategy and keep the two that are working well. So it kind of gives you a little hedge because you're now global in your thinking, global in your investing. And some of that, remember, you're going to be looking at some of these indices that are out there that are in foreign markets that you may say, hey, listen, I'm pretty comfortable with Canada. I'm pretty comfortable with Europe. Asia is really a pretty established market, but there are third world emerging where there could be places to profit from it. But remember, it's really young. Some of those markets are really young. They're not tested. They don't have historicity. You just have to remember what the risk you're getting yourself into. Remember, one of the big things behind the curtain here is also the currency exchanges between different governments. And right now you have to be very soft because the US dollar is still the mark, it's the reference point, it's the benchmark for all securities in the world. You have to look at how you're buying. If you're buying foreign, you have to understand you have currency issues and just have to remember to be soft and at least bring yourself up to speed that could influence some of your performance issues. Again, I'm just giving you a little bit here. There's a lot more indexing than these. I'm just giving you the major boilerplate here. Indexing is a great idea. It has established markets like Europe and Asia and the United States and Canada. They have secondary markets that are in third world countries that could be really places to play. Third world markets that really could be places that have maybe opportunities in the future. But again, you have to remember, they may not be as established as some of these other ones. In the United States, Most people that do indexing, they're almost all, I don't want to say all, but a good majority of Americans tend to lean to the S&P 500 index. They know it, they can see it on TV, they can see its VIX report, the volatility report. They feel comfortable with going that route. So just remember, be comfortable, look at the actual risk scenario. Remember, you're playing in indexing, it's a security. You could lose your money. You just have to keep your heads up what your risk tolerance is for funds like this. Don't forget to watch our next segment on indices as benchmarks to gauge success, part 4 in our series on index investing. And keep in mind, before moving forward with any of the ideas on our show, always check with your tax consultant, legal counsel, and financial advisor. You've been watching Steve Savant's Money, the name of the game.